In a matter of weeks, Bitcoin's price didn't just dip, it completely fell off a cliff. And now everyone's asking the same question. What happened? Or maybe, who happened?
We're talking about a 40% drop. Just gone. Billions in value vanished, pushing Bitcoin to its lowest point all year. You're looking at the crime scene.
So, was this just a random act of market chaos? Or did someone or something push it over the edge? We're going to investigate, and we have three main suspects.
All right, our investigation kicks off in Asia. And our first suspect? Let's call them the gamblers. We're talking about a group of high-stakes hedge funds in Hong Kong, and they were making some absolutely massive, risky bets on Bitcoin.
So how were they doing it? They were using something called leveraged bets. Now, put simply, that just means they were gambling with borrowed money, a lot of borrowed money. And sure, if the bet pays off, the profits are huge. But if the market turns against you, the losses can be, well, catastrophic.
And here's the crazy part, the mechanism they used. It was actually pretty clever, but also super dangerous. They were borrowing Japanese yen, right? Because the interest rates were practically zero. Then they'd swap that cheap yen for other currencies and just pour it all into risky assets like Bitcoin, betting the price would just go to the moon.
But then, the bet went south, hard. Bitcoin's price completely stalled out, and at the exact same time, the cost to borrow all that yen started to creep up. Lenders started to panic. They wanted their money back, and they wanted it now. This forced the funds into a total fire sale, dumping all their Bitcoin at once, which just threw gasoline on the fire.
In the chaos, it was just staggering. I mean, on one single day, BlackRock's Bitcoin ETF saw a record-shattering $10.7 billion in trading volume. That's almost double its previous all-time high. This wasn't some small tremor, you guys. This was a full-blown earthquake. Okay, but the gamblers might not have acted alone. Let's turn to our second suspect, the insiders. This theory is wild because it suggests the crash got way worse thanks to the very guardians of the financial system, the big banks themselves.
And their weapon of choice? A really complex and frankly terrifying market condition known as negative gamma. The best way to think about it is like a financial death spiral. It's a state where selling literally forces more selling. It's a feedback loop that just feeds on itself, pushing the price down, down, down.
Now, according to former BitMEX CEO Arthur Hayes, this is exactly the trap the major banks walked into. See, they'd sold all these complex financial products that were tied to Bitcoin's price. So when the price started to drop, they couldn't just sit on the sidelines anymore. They went from being market makers to forced sellers.
And here's how that death spiral actually worked, step by step. First, Bitcoin's price falls below a key level. Then, to hedge their own risk, the bank's systems automatically force them to sell their own Bitcoin. But of course, that selling from the banks pushes the price down even further, which, you guessed it, triggers the next wave of forced selling, a total vicious cycle.
All right, we've got the gamblers and the insiders. But our third and final suspect points to a threat that's maybe even scarier because it's an attack on the very foundation of Bitcoin itself.
We're talking about the Bitcoin miners. You know, the massive computing operations that act as the guardians of the network. They secure everything, they validate transactions, they're absolutely essential. And here's the problem. They're starting to abandon their posts. And if you look at the numbers, you'll see why. It's a brutal story. With Bitcoin's price hovering around $60,000, it's costing the average miner almost $73,000 just to produce one coin. Do the math. They're losing almost 13 grand for every single Bitcoin they create. Their entire business model is completely broken.
So what do you do when your business is bleeding money? You find a new one. You pivot. And that's exactly what's happening. Big miners like Riot Platforms and Iron are starting to shift their massive computing power away from Bitcoin and towards the incredibly profitable world of AI data centers.
And listen, this isn't some small, insignificant shift. One analyst, Judge Gibson, is calling it the Great Pivot. He says it's already led to a 10 to 40% drop in the network's hash rate. And just so we're clear, the hash rate is basically the network's pulse. A lower hash rate means a weaker, less secure, and less healthy Bitcoin.
So there you have it. The gamblers, the insiders, and now the defectors. We've investigated all three. So what's the final verdict? Who done it?
Well, think about it. The market got hit from three different directions, all at the exact same time. You had the reckless leverage from the gamblers blowing up.
You had the negative gamma death spiral forcing the insiders to dump their holdings. And you had the network's own guardians, the defectors, literally starting to unplug their machines.
And that's the hidden truth here. It wasn't one single culprit. The real story is the collision. The crash wasn't caused by one of these things. It was caused by the moment they all slammed into each other at once. It created a perfect storm that the market just couldn't handle.
So, case closed, right? Well, not exactly, because the story isn't really over. This verdict actually reveals something much, much bigger about where Bitcoin is heading.
What this crash really was a massive stress test, and it revealed some brand new vulnerabilities. See, Bitcoin isn't this isolated niche asset anymore. It's now deeply tangled up with traditional finance, which makes it vulnerable to all of Wall Street's domino effects. And at the same time, its own security, the mining network, is now in direct competition with the absolute gold rush that is AI.
And we're already seeing the fallout. The data is showing us that even the big long-term holders, what people call the smart money, they're getting nervous. The amount of Bitcoin they hold has dropped to a 9-month low. They're not buying this dip, they're actually trimming their positions.
Which leaves us with one last really big question. As Bitcoin gets pulled deeper and deeper into the worlds of both Wall Street and big tech, is it starting to lose the very thing that made it so special in the first place? Is it just becoming another cog in the very machine it was built to disrupt? Or are we watching the painful birth of something else entirely?